Elon Musk spoke at Cannes Lions convention today, and it's making a lot of headlines. In fact, it's the top headline on CNBC. It reads, Elon Musk softens "Go F yourself" comment as he tries to woo advertisers back to the platform. Elon Musk goes on to say that he was not targeting the advertising community, he was just saying he believes in freedom of speech. And if you don't believe in freedom of speech, then go F yourself. Which, who doesn't agree with that? But beyond just the X comments that he made, and there was quite a bit of them, Elon Musk also had some pretty interesting things to say about AI. Elon Musk shared this post and says it's a good summary of the talk that he did. Elon Musk says every human will have a humanoid robot. I think there will be 20 billion humanoid robots. That is what he just said at Tesla's shareholder meeting. He also says companies that will succeed are those that most effectively use AI. AI is an immensely powerful tool providing better answers than a collection of links and enabling real-time aggregation of collective wisdom. Elon says, I tend to agree with Geoff Hinton, one of the godfathers of AI, and he thinks there's a 10 to 20% probability of something terrible happening. The glass is 80% full. Look on the bright side. He goes on to say there will be a crisis of meaning with AGI and robots. What is our purpose when we don't have to work? We are heading to an age of abundance. If AI can do everything you can, but do it better, what's the point of doing things? I think there will be an existential crisis. I think the most likely outcome is one of abundance, where goods and services are available to anyone. There's no shortage of any one of us. It would be a universal hike. Work would be optional. Some pretty strong comments there from Elon Musk. And if any of those predictions come true from Elon Musk, Tesla is going to be a fantastic investment, because Tesla is going to help power the world of abundance, especially with robots, but also full self-driving. Full self-driving is the biggest AI project in the world that is actually possible to finish. Generalized robots are also possible. We have seen concepts, we see robots doing things today, but it will be some years before you're able to purchase a robot and have it do generalized tasks around your home or business without error. And that's really the longer term vision with Tesla. As I've said many times here on this channel, the only thing bigger than full self-driving besides robots is something like gene editing, where if you're sick, you have something wrong with your genes, you go edit it out and boom. I mean, I think that could be bigger than full self-driving because of it could affect literally everyone. But full self-driving is the next best real-world use case for AI behind robots that are, again, many years away on a generalized multi-purpose basis. So let me know your thoughts around all of that. This is obviously a longer-term vision, and that's why we are investors in Tesla. Wall Street just doesn't understand what Elon says half the time. And I think inevitably Tesla stock will reflect the long-term value creation and or potential that Tesla has. It's actually crazy that Tesla is still at $185 per share and not $50, given the highest interest rates we have seen in Tesla's entire business history. Slower sales than expected, and yes, the uncertainty about a recession. And I think we need to talk about that as well, a potential recession. Now, if you guys have watched any of these videos posted on this channel within the last couple of days, you will know I am pretty concerned about broader markets. I think the Fed is pushing us into a recession or close to a recession, and by the time they start cutting rates, markets are gonna crash. I mean, historically, when the Fed makes an error and cuts rates, the S&P drops over 20% and takes about 200 days to bottom and then start to recover. So yes, historically, when the Fed cuts rates, markets go into a bear market. They crash. And I've really gotten more defensive. I wouldn't say bearish, but defensive, raising more cash. I want to keep some hedges on the portfolio around big catalyst because of last week's Fed meeting. I know a lot of people were under the impression that when the economy started weakening, the Fed would cut rates. In fact, that has already happened. The unemployment rate has went from 3.4% to 4%. And the Fed last week pushed back on cutting rates. They were more hawkish than they were when the unemployment rate was 3.4% and inflation was slightly higher than it is today. I mean, last week should have shown everyone that the Fed is not going to stop keeping rates higher for longer until they see some kind of material weakening. That would be the unemployment rate spiking a lot. That would be a potentially negative jobs report or something along those lines. And if the Fed starts to cut because of those reasons, markets will panic and stocks will sell off. If you guys don't take my word for it, maybe you'll take Wall Street's word for it.
Interesting. The idea if they do cut, it's going to be bad. It's not going to be for the right reasons because inflation's coming down. It's going to be for the wrong reason. And right now they don't need to do anything. The economy is in good standing. What do you make? What do you make of that?
Well, I think the Fed does want to cut rates. I know as the investment community, we would like to see them. But I agree with Keith's point. And what we shouldn't maybe be asking isn't when they cut rates. It should be why they cut rates. So if we look at a situation where they're cutting rates because we went into a recession, that's problematic. They can throw as many rate cuts at us as they want. It's not going to save anything. So this is a very thin needle that they've got to thread. I do think they're going to cut rates one time at the end of this year. But in the longer term, whether it's November, October, December, February, it doesn't really matter. It's affecting short-term trading.
You say the consumer's on the cusp of a significant slowdown. Was there anything in this report in particular that adds to this thesis?
Certainly the data were weaker. I think in particular, one of the things that Steve pointed to, the fact that restaurant receipts were down. I mean, that to me is kind of the ultimate discretionary category. And we've seen declines in 4 of the last 6 months at restaurants. So that is one signal. I think in general, we need to also pay much attention to the consumer spending data that are going to come at the end of the month, because most of the action for the consumer lately has been on the services side. So goods weakness alone is probably not enough to really move the needle for the Fed.
Yeah, the restaurant line item, Steve Leisman, stood out to me as well, and especially given that the consumer had a little bit of relief from lower gas prices overall, lower fuel prices, and yet they still felt the need to pare back on what they're spending out. It was the biggest decline that we've seen since January. What do you make of that? And you said that most economists didn't really see much in the retail sales data that makes them too concerned. So
right.
Can you put that into context for us?
Well, I have two thoughts on this, and I wonder if Stephen would comment on. I have been thinking about just this very question, Melissa. The first thing is, I think there's a rejection. I was talking a couple of days ago about this idea of the $30 2-beer and burger bill. I think people are recoiling a little bit at that. No matter what your income level, when you go out to something that used to be $20 and now it's $30, you're like, well, wait a second. I think I'm going to lay off of that. And I think we may be in the process of some disinflation or deflation. I don't know, Stephen, how the bean counters figure out when McDonald's goes to the $5 meal, and I'm talking about necessarily McDonald's all the time, but some of these other fast food value meals that are out there, there could be some disinflation in this food.
Stephen, let me tell you right now, if we continue to see disinflationary or deflationary pressures that start to pick up even more in the economy, that is a red flag of a recession to come. The U.S. economy very rarely, very, very rarely ever sees deflation. So if you start to see deflation, then that's a sign the economy is really starting to slow. And in fact, headline inflation month over month last month came in at 0%, so pretty close to deflation. And your PPI that came out a day later came in at 0% for core PPI. So very close to deflation when headline PPI came in at negative 0.2%, which is deflation. Now, ultimately, what does this crash-like event mean for Tesla, number one? And how is this event going to happen? I will tell you right now, there's 2 different ways the markets can go through a large crash, and that's really it. Number one is if NVIDIA were to miss on earnings. Now, I'm not necessarily going to call for that. Eventually, it will happen. Do I think it's going to happen late August, NVIDIA's next earnings? Not necessarily. as the economy weakens, as the consumer pulls back, as companies start to look at their expenses and say, we have enough NVIDIA GPUs, we don't need any more because we're not making a product yet with all of this investment, and that could become a major problem. And again, if you don't take my word for it, maybe you'll take Wall Street's word for it.
You're excited about things that are other than just the big five. I guess some people are questioning whether the concentration risk and outperformance is healthy for the overall market.
Well, healthy is sort of a pejorative term, but I would say it would be better if there was wider breadth in terms of the performance in the market. There's lots of opportunities in the market in terms of performance, and talk about that every day. Some of the GLP-1 drugs. The real story that everyone's discussing, all the questions that come to us relate to AI. And we think about AI in a couple of phases. NVIDIA, big winner, obviously. With the infrastructure build-out companies, yes, some of the hyperscaler companies, some of the semiconductors clearly benefiting. ARM, TSMC, kind of other aspects of the infrastructure build-out. And there's been much more skepticism around the sort of enabler, the revenue companies that will, the benefits of widespread adoption of AI. And the question, Carl, is about what is the return on investment of all those AI dollars. And that, I think, is a big question. It remains to be answered, but you'll start to see that in the next couple of quarters. If there's not some evidence that there's a return on this money, then I think a lot of investors will start to ask, is a real story there?
So as you guys may or may not know, I watch basically every clip that comes out on CNBC every day because I like to stay informed of what big money is thinking and saying. I think that can give you a competitive advantage. And when I heard that, it was like music to my ears, because that's the real problem, I'll say, with Microsoft, Apple, Amazon, all of these companies that have spent tens of billions of dollars on NVIDIA GPUs that have no products that they're selling, bringing in nothing from that AI investment. At some point within the next 12 months, I'll say, I think more conservatively the next 12 months, but the next really 1 to 2 quarters, probably this upcoming earnings season, Wall Street will start to demand results from AI, from all of this investment. And if you're not seeing results from this investment, which I know we're not, because there's no products that are coming out that are, drivers of results, then Wall Street will start to cut back their AI investments, and that, I think, is a problem. Essentially, right now, you are in a bubble of expectations. I don't think on a valuation basis, you're in a bubble necessarily. You very well could be, because what if next year, NVIDIA revenues are half of what they are this year? Then the multiple is way higher than it is today. So expectations could be a little off. I think longer term AI is the obvious future, but in the short term, if companies are not seeing a return on investment on these, tens of billions of dollars they're flowing into AI, Wall Street will start to punish those companies. They will start to force those companies to retract some of their AI investments. So that's one reason why I think it's only a matter of time before you get some kind of crash in our markets, because again, expectations are very high and we're not going to be able to meet those expectations. Again, when companies are not putting up AI-like results, actually making money from their investments, which you'll see over the next 1 to 2 quarters, as that individual said, then there's going to be maybe even a revolt against all of the AI spending. And I think given the lofty expectations, clearly NVIDIA, the most valuable company in the world, and NVIDIA really touching everyone else in your big tech stratosphere that accounts for a vast majority of the market weighting in the S&P and the NASDAQ, when that happens, if there is nothing else to fall back on, a strong economy, low rates, if we're just in this same market environment we're in, that's a problem, like a big problem. Now, the second scenario in which we get some kind of markable market downside would be when the Fed makes an error, the unemployment rate rises too much, we'll get the next jobs report on July 5th. If it starts to look like we're heading into a recession, something along those lines, the Fed starts to cut rates, that's again going to lead to a crash. Preferably, you would have wanted to see the Fed already cut rates this year, because then it would have been some weakness, but maybe not enough to cause recession fears. The Fed made it clear again, they are going to wait until some kind of shock data comes out, some kind of big weakening happens to start cutting rates. So I think that in and of itself is kind of setting us up for disaster eventually. That could be as soon as July 31st, the next Fed meeting. If this, July 5th jobs report is really bad, then you could set yourself up for a cut coming July 31st. That would not be good. If not, it's going to be the end of August, September, November, or December. The worst possible case scenario, which I'm honestly a little concerned about, pretty concerned about, a matter of fact, is the combination of both of those things. What if we see companies that are unable to generate results from AI in the near term? Because again, AI is a multi-decade kind of thing. And Wall Street wants it in the next 1 to 2 quarters. Wall Street wants it right now. They want some return on investment on these AI chips. That's not going to happen. Problematic. Problem. Okay. So what if you have that? At the same time, the Fed is making an error and the economy is going into recession. That would be the ultimate worst case scenario. The AI thesis getting blown up, and the economy going into recession, or just looking like it's going into recession, causing the Fed to cut rates. The markets, when the Fed cuts rates, if you don't know, they always jump to, oh my gosh, what's going on? Why is the Fed cutting rates? They don't necessarily need to cut rates, but they're cutting rates. Is something about to get worse? The markets presume that the Fed knows more than we do about the economy, which is clearly not true, or the Fed would be already cutting rates. But that's how the markets look at it. When the Fed starts to cut rates, especially when the economy is weakening, markets start to say, how bad are things going to get? So honestly, I'm concerned about both of these things happening at the same time. I think one or the other is bad enough. AI proving that it's a longer term game, not in the short term going to see massive results, which I think we can all agree with that. The next 1 to 2 quarters, don't expect anything great from these AI investments. Now again, mix that with the Fed making an error, cutting rates, and the markets panicking about that, and you could see the markets down 50+% from here. Now, for anyone that is an investor in a stock like a Tesla, small caps, mid caps, basically everything besides your big tech, I think there is a silver lining to all of this. Let's be honest, Tesla, none of those names that I mentioned, categories that I mentioned, have any AI hype associated with them. So instinctively, you're only going to, lose from that side of the Fed making a mistake and cutting rates. So you don't have that double whammy like a Microsoft, like an Nvidia, some of these other stocks, or a Google, Amazon for that matter. Now, you will still get downside in Tesla in those areas of the markets that I just mentioned when that crash does ultimately happen. But I think it'll be one of those things where investors will say, wow, these stocks just got cheaper, during the crash or at the lows of the crash. And when the markets realize the recession's not going to be as bad as they think, no, I don't think it's going to be an 2008. No, I don't think we're going to be standing outside in lines for soup like the Great Depression. That's not what I'm forecasting here. I think the markets will realize it's not as bad as we panicked about. Rates are now low. Inflation is low. Tesla can do well in that environment. So yes, I think there is a better buying opportunity coming, but I do think that can start a multi-year bull run for everything, not just 7 stocks. So then I am expecting, on my estimates, the second half of 2025 is probably when you can start to see that multi-year bull market. I think at some point towards the end of this year, maybe, mid to late summer, if not the first half of 2025, the day of reckoning will come, whether it's from AI, whether it is from the Fed, or both. Again, worst case scenario is both at the same time. Either way, I think the second half of 2025, call it a year from now, is going to be much better. Now, why is this so beautiful? Because you are getting a massive heads up on this right here, right now, if you're listening to this video. You have a whole year to save as much cash as possible to get ready for these events and be able to take advantage of it. Did you know recessions create more millionaires than lottery winners by like 10 or 20x than like the lottery ever has? A lot of money can be made during recessions. You have to have money to take advantage of it. And again, whether or not we go into a recession, I think is irrelevant in this conversation. The point is, in this video, I hope you take advantage of this information. I don't know when these things will happen, but indeed they will happen. Again, I'm not a financial advisor. I'm not a financial planner, so come to your own conclusions. Most importantly, let me know what you think about all of this information down below in the comment section. If you want to come be ready for anything that the markets throw at us, come join the trading community. Link down below in the description of this video. You guys have a fantastic rest of your day, and I will see you in the next one.